or wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets. And this is with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And the way we do that is by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 199, and in this episode we're reviewing the performance of the financial markets during the 6th week of 2026, and that is from Monday the 9th to Friday the 13th of February. And without further ado, this is your host, Jamhuri, and together, let's dive right in. We kick it off in the United States, where the growth in jobs was stronger than expected in January 2026, providing some relief to concerns about the state of the U.S. labor market. According to seasonally adjusted figures from the Bureau of Labor Statistics that were released on Wednesday, Nonfarm payrolls increased by 130,000 in January, which was above the Dow Jones consensus estimate for 55,000 jobs, and was a major improvement over the December report, which saw a gain of 48,000 jobs. In tandem with these figures, the unemployment rate edged lower to 4.3%, down from 4.4% in December 2025. Staying in the United States, the cost of goods and services rose at a slower than expected annual rate in the month of January, providing hope that the challenge of sticky U.S. inflation could be starting to ease off. According to a report from the Bureau of Labor Statistics, the Consumer Price Index for January increased by 2.4% over the past 12 months, down from 2.7% in December, and was also lower than the consensus estimate of 2.5%. Excluding food and energy prices, the core consumer price index was up by 2.5%, which was the lowest rate since April 2021. Over to the United Kingdom, where, according to preliminary data from the Office for National Statistics that was released on Thursday, the UK economy grew by a meager 0.1% in the fourth quarter of 2025. Economists polled by Reuters expected the economy to have grown by 0.2% in the fourth quarter, following a growth of 0.1% in the third quarter of 2025. The UK economy is estimated to have grown by 1.3% for the full year 2025, following an annual growth rate of 1.1% in 2024. The growth figures came after the Bank of England voted to keep its policy rate on hold at 3.75%, given the issue of persistent inflationary pressures. However, those pressures are expected to ease off in the coming months, and economists predict that the central bank could cut interest rates in April in order to stimulate the British economy. On Wall Street this past week, the S&P 500 barely closed above the flat line on Friday as the consumer inflation report came out slightly cooler than expected, and this failed to spark a substantial rally in the stock market. The slowdown in inflation is good news for the markets, as well as the incoming Fed chairman, Kevin Warsh, who is expected to advocate for lower interest rates. However, as we like to say in the markets, one data point does not constitute a trend, and we will have to wait and see if this trend is sustainable. All the three major averages posted declines for the week, with the S&P 500 sliding by 1.4% and posting its second consecutive losing week before coming to a close at 6,836, and the 30-stock Dow Jones Industrial Average dropped by 1.2% during the week before settling at 49,500, whilst the tech-heavy Nasdaq Composite recorded a weekly decline of 2.1% as it came to a close at 22,546. In the government bond market, U.S. Treasury yields slipped on Friday after January's consumer inflation report came out slightly cooler than expected. Based on this latest inflation report, the markets are projecting further rate cuts in the near term, especially on the back of the incoming Fed chairman. However, the stronger than expected jobs report for January has cast some doubt and could make rate cuts less likely, as the fiscal stimulus from recent tax cuts provide a boost for economic growth. The yield on the 2-year Treasury note slid by 6 basis points to close at 3.40%, whilst the yield on the benchmark 10-year Treasury bond dropped by more than 5 basis points to settle at 4.05%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall and vice versa. In the commodity markets, the price of crude oil held steady on Friday after data showed an overall slowdown in U.S. inflation. The thinking here is that cooler inflation is likely to lead to lower interest rates, which in turn could boost economic activity and in particular increase the demand for fuel oil. Oil prices had increased earlier in the week on concerns that the U.S. could attack Iran over its nuclear program. However, comments about a possible deal between the two countries over the next month drove down prices on Thursday. Both oil benchmarks were headed for weekly declines after incurring losses of about 3% on Thursday. Brent crude was headed for a weekly loss of 0.6% as it came to a close at $67.75 a barrel, whilst the U.S. benchmark, West Texas Intermediate crude, declined by 1.2% during the week before eventually settling at $62.89 per barrel. In the precious metals market, The price of gold rose more than 2% on Friday as cooler than expected U.S. inflation data offset concerns about a stronger than expected jobs report and reignited hopes that the Federal Reserve would cut interest rates sometime later this year. According to data compiled by LSEG, market participants are currently pricing in a total of 63 basis points in rate cuts this year, with the first rate cut expected in July. For your information, gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. And after falling about 3% on Thursday, the price of spot gold recovered on Friday and was up by 2.25% before eventually settling at $5,030 per ounce. We now change scene to the Kenyan financial markets, and we start by looking at the decision by the Monetary Policy Committee, where the Central Bank of Kenya held its policy meeting this past week on Tuesday, the 10th of February. The Central Bank's Monetary Policy Committee made the following observations. The first was that global growth has remained resilient and was estimated at 3.3% in 2025. Meanwhile, global inflation declined in 2025 and is projected to decline further in 2026, mainly driven by lower energy prices and reduced global demand. Consequently, central banks in the major economies have continued to ease monetary policy, albeit at a cautious and uneven pace, depending on their outlook for inflation and growth. On the domestic front, the Kenyan economy remained resilient in the third quarter of 2025, with a real GDP growth of 4.9%. Meanwhile, Kenya's overall rate of inflation declined to 4.4% in January 2026 and is expected to remain below the midpoint of the central bank's target range in the near term. The banking sector remains stable and resilient with strong liquidity and capital adequacy ratios, as the percentage of gross non-performing loans declined slightly to 15.5% in January 2026. The committee observed that the average lending rates in the domestic market continued to decline, whilst credit to the private sector continued to grow, but at a slower than desirable pace of 6.4% in January 2026. To further strengthen the effectiveness of its monetary policy implementation framework and to further enhance monetary policy transmission, the committee approved the narrowing of the interest rate corridor from 75 basis points down to 50 basis points, either above or below the central bank rate. The committee also made an adjustment to the interest rate applicable at the discount window, reducing it from 75 basis points down to 50 basis points above the central bank rate. And having considered all these major developments, the Central Bank's Monetary Policy Committee concluded that there was scope for further easing of monetary policy and therefore decided to lower the central bank rate by 25 basis points from the previous rate of 9% down to 8.75%. In the domestic foreign exchange market, the Kenya shilling continued to trade sideways versus the US dollar, and according to data from the Central Bank of Kenya, the official exchange rate for the dollar remained unchanged from the previous week at 129.02. Meanwhile, the sterling pound was priced at 176.33 and the euro was valued at 153.23. And on the regional front, one Kenya shilling was changing hands for 27.39 Ugandan shillings and 20.02 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.28. The IMF has previously raised concerns about the extreme stability of the Kenya shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been staggered between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased by $98 million for a grand total of $12.48 billion, which is equivalent to 5.4 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. On diaspora remittances, the inflow of remittances to Kenya totaled to $411 million in January 2026, and this was down from $427 million in January 2025, a decrease of 3.8%. The cumulative inflows for the 12 months to January 2026 increased by 1.2% to $5.02 billion. The inflow of remittances remains a key source of foreign exchange earnings and continues to support the country's balance of payments as well as the domestic foreign exchange market. In the money markets, during the past week, the interbank market remained well-funded and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate declined to 8.78%, which is in sync with the revised central bank rate, which now stands at 8.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 12.7 billion shillings. And just for your information, the cash reserve ratio is a statutory requirement that specifies a percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 12th of February, and the central bank received bids totaling to 74.1 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of 308%. The central bank ended up accepting about 44.8 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 2 basis points to settle at 7.60%, whilst the 182-day rate ticked lower by nearly 2 basis points to average out at 7.77%, and the 364-day rate fell sharply by 22 basis points for a weighted average rate of 8.97%. In the primary bond market, the auction for the monthly bond issuance was held on Wednesday, the 11th of February, and the central bank received bids totaling to 213 billion shillings, and this was against an advertised amount of 50 billion shillings, representing a performance rate of 427%. The central bank ended up accepting about 100 billion shillings, and the results of the auction were as follows. For the first bond, which is a 15-year bond that was initially issued in 2019 and now has 8.4 years left to maturity, the central bank accepted 54.7 billion shillings at a weighted average rate of 12.18% compared to the bond's coupon rate at 12.34%. And for the second bond, which is a 25-year bond that was initially issued in 2018 and now has 17.3 years left to maturity, the central bank accepted 45.7 billion shillings at a weighted average rate of 13.36% compared to the bond's coupon rate of 13.40%. Up next is our topical issue, and this week we're looking at the official launch of Ziidi Trader at the Nairobi Securities Exchange. This past week, the Nairobi Securities Exchange underwent a momentous transformation as it partnered with Safaricom to launch the Ziidi Trader. Ziidi Trader is a new feature within the M-Pesa application that allows retail traders to buy and sell shares directly from their mobile phones. Before the official launch on Tuesday, the 10th of February, the platform was already handling about 55% of all share transactions at the exchange, confirming a real demand for this service, which provides easy access to the stock market. However, the value of shares traded on Ziidi Trader accounted for only 2% of the total value, indicating that the success of this service will depend on drastically increasing the volume of business. As a retail investor, this is what you need to know about Ziidi Trader. The first thing is seamless access, which means you can find Ziidi Trader as a mini app under the Financial Services tab in the M-Pesa application. The second fact is that no paperwork is required as the platform uses existing M-Pesa Know Your Customer credentials, so there is no need to upload documents or fill out any forms in order to sign up. And number 3, no individual CDS accounts are required. So instead of opening an individual Central Depository System account, funds are pulled into a collective account that is managed by Kestrel Capital. Please note that even within the pooled funds, you as an individual will remain the legal owner of your shares and you will receive dividends and retain voting rights. Number 4 is that Ziidi Trader gives you full control and you can view real-time stock prices. You can also track performance of your portfolio in terms of profit and loss and set your own buying and selling prices. So in summary, while Ziidi Trader currently accounts for only about 2% of the total value traded, this is largely due to the mobile transaction cap limit of 500,000 shillings. However, going forward, the sheer volume of orders suggests that retail investors are about to become a very popular segment at the exchange. So how do you get started? Simply opt in via the M-Pesa application and use your PIN to activate the service and enter a one-time password that will be sent to you by Safaricom to unlock this trading platform. All said and done, this is another major milestone for retail investors in Kenya, once again showcasing Kenya's ability to continuously create innovative solutions for the domestic market. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, don't let what you cannot do interfere with what you can do. A quote by John Wooden. Think about it. Thank you, and God bless.